Top 20 Cost Accounting Interview Questions and Answers. Preparing for a cost accounting interview? These top 20 questions and concise answers will help you demonstrate your technical knowledge, practical application skills, and decision-making expertise effectively. 1. What is cost accounting and how does it differ from financial accounting? Cost accounting focuses on capturing, analyzing, and controlling costs related to production or operations to help management make strategic decisions. It includes tracking direct and indirect costs, evaluating efficiency, and calculating cost per unit. Financial accounting, on the other hand, involves preparing financial statements for external stakeholders like investors and regulators. While cost accounting is internal and forward-looking, financial accounting is historical and external. The main difference lies in their purpose. Cost accounting aids internal decision-making, whereas financial accounting ensures compliance and reporting accuracy. 2. Can you explain the different types of costs? Fixed, variable, direct, and indirect? Fixed costs remain constant regardless of production levels, e.g., rent, salaries, while variable costs change with output, e.g., raw materials. Direct costs are traceable to a specific product or job, such as labor or components used in manufacturing. Indirect costs, like utilities or administrative salaries, are not directly attributable to a single product but are necessary for operations. Understanding these categories helps businesses forecast expenses, calculate product pricing, and improve cost efficiency through better allocation and budgeting. 3. What is a cost sheet and what are its components? A cost sheet is a detailed statement that shows the total cost incurred to produce a product. It includes elements such as prime cost, direct materials, direct labor, and direct expenses, factory overheads, administrative overheads, selling and distribution expenses, and total cost of production. The final section often includes the cost per unit. A cost sheet helps management analyze production costs, set selling prices, and control unnecessary expenditures. It is a key tool for budgeting, planning, and profitability analysis. 4. How do you calculate the break-even point? The break-even point is the level of sales at which total revenue equals total costs, resulting in no profit or loss. Break-even point, units, equals fixed costs, selling price per unit, variable cost per unit. This analysis helps businesses determine the minimum output needed to avoid losses. Understanding the break-even point aids in pricing decisions, cost control, and financial forecasting. It's especially useful for new product launches and investment evaluations. 5. What is standard costing and how is it useful? Standard costing involves assigning predetermined costs to materials, labor, and overhead based on expected efficiency and rates. These costs serve as benchmarks for performance. Actual costs are compared against standard costs to identify variances. This technique helps in budgeting, cost control, and variance analysis. It simplifies cost tracking and highlights inefficiencies or deviations. Managers use it to implement corrective actions and ensure cost-effectiveness in operations, making it a valuable tool for internal control and decision-making. 6. Explain variance analysis and the types of variances you've worked with. Variance analysis involves comparing actual costs and revenues to standard or budgeted figures to identify deviations. Key types include material variances, price and usage, labor variances, rate and efficiency, and overhead variances, spending and efficiency. For instance, if actual labor costs exceed standard costs, a labor rate variance occurs. I've used variance analysis to identify cost overruns, investigate root causes, and recommend process improvements. It's a critical tool for cost control, performance measurement, and continuous improvement in financial management. 7. What is activity-based costing, ABC? How is it different from traditional costing? Activity-based costing, ABC, assigns overhead costs to products based on activities that drive costs, like machine hours or setup time. Unlike traditional costing, which applies overhead based on a single volume measure, e.g., labor hours, ABC provides more accurate cost allocation by identifying multiple cost drivers. This method helps in understanding true product costs, especially in complex environments with varied products and indirect costs. ABC supports better pricing, process improvement, and strategic decision-making. 8. How do you allocate overhead costs to products? Overhead costs are allocated using methods like direct labor hours, machine hours, or activity-based costing, ABC. The chosen method depends on the nature of the business. For example, in labor-intensive environments, overheads might be allocated based on direct labor hours. ABC offers a more refined approach by linking costs to activities that generate them. Proper overhead allocation ensures accurate product costing, which is essential for pricing, profitability analysis, and cost control. 9. What is marginal costing and how is it applied in decision-making? Marginal costing considers only variable costs in decision-making, treating fixed costs as period costs. It calculates the contribution margin, sales of variable costs, to determine the impact of producing one additional unit. This technique is valuable in short-term decisions like pricing, make-or-buy analysis, and product mix optimization. For instance, a company might accept a low-margin order if it contributes positively to fixed costs. Marginal costing supports flexible decision-making and helps evaluate the financial implications of incremental changes. 10. Can you explain job costing versus process costing? When would you use each? Job costing tracks costs for individual jobs or projects, ideal for customized or unique orders like construction or consulting. Costs are assigned per job, allowing detailed analysis. Process costing is used for mass production of identical items, like in chemical or food manufacturing. Costs are averaged over units produced in a process. Choose job costing when each product varies, and process costing when production is continuous and uniform. Both methods help in cost control and pricing strategies. 11. What are the common methods of inventory valuation in cost accounting? Common inventory valuation methods include FIFO, first in, first out, LIFO, last in, first out, and weighted average cost. FIFO assumes the earliest goods purchased are sold first, while LIFO assumes the most recent purchases are sold first. Weighted average calculates an average cost per unit of inventory. The chosen method affects cost of goods sold (COGS) and profit margins. For example, FIFO often results in lower COGS during inflation. Accurate valuation helps with financial reporting, tax planning, and profitability analysis. 12. How do you handle underabsorbed or overabsorbed overheads? Underabsorbed overheads occur when actual overheads exceed allocated amounts, while overabsorption is the opposite. These variances can be adjusted by apportioning them to cost of sales, inventory, or transferred to a profit and loss account, depending on materiality. Causes like inaccurate budget estimates or production volume changes should be analyzed. Effective overhead absorption ensures accurate product costing and financial statements, improving decision-making and cost control. Regular reviews and revisions to absorption rates are essential for accuracy. 13. What is cost volume profit, CVP, analysis, and why is it important? CVP analysis examines how changes in costs, volume, and pricing affect profits. It helps determine the break-even point, margin of safety, and optimal sales mix. Key components include fixed and variable costs, contribution margin, and profit targets. CVP is useful for pricing decisions, budgeting, and strategic planning. For example, a manager can evaluate how much to sell to achieve a target profit. It provides insight into the financial impact of operational changes, supporting data-driven decisions. 14. How do you ensure accuracy in cost accounting reports? Accuracy is ensured by maintaining consistent accounting practices, performing regular reconciliations, validating source data, and applying proper cost allocation methods. Automation tools can reduce manual errors. Internal audits, cross-checks, and variance analysis also help detect and correct inaccuracies. Clear documentation and adherence to standards like GAAP or IFRS improve reliability. Accurate reports are crucial for decision-making, compliance, and strategic planning, ensuring that management has trustworthy information to guide business operations. 15. What are the key differences between cost control and cost reduction? Cost control involves monitoring expenses to ensure they stay within budget, focusing on adherence to standards. Cost reduction seeks to lower costs permanently without compromising quality. For example, cost control might track utility usage, while cost reduction could involve switching to energy-efficient systems. Control is preventive, reduction is corrective. Both are essential. Cost control maintains efficiency, while cost reduction drives competitiveness and profitability. Together, they help businesses manage resources effectively and stay financially healthy. 16. Explain the concept of lifecycle costing. Lifecycle costing estimates the total cost of ownership of a product or asset over its entire life, from design and production to operation, maintenance, and disposal. It helps businesses evaluate long-term costs and profitability. For instance, a product with a low initial cost may have high maintenance costs over time. This approach supports sustainable decision-making, product development, and investment appraisal. It's especially useful in capital-intensive industries like construction, manufacturing, and infrastructure, where long-term planning is essential. 17. How would you use cost accounting data to support managerial decisions? Cost accounting data supports decisions like pricing, budgeting, resource allocation, and process improvement. For example, contribution margins can guide product mix choices, while cost variances identify inefficiencies. Overhead analysis helps in evaluating profitability by department or product line. Managers rely on accurate cost data to control expenses, set strategies, and evaluate performance. It transforms raw financial data into actionable insights, enabling businesses to enhance productivity, reduce waste, and make informed strategic moves. 18. What tools or software have you used for cost accounting? I've used tools like SAP, Oracle, QuickBooks, Tally, and Microsoft Excel for cost accounting tasks. SAP and Oracle are excellent for large-scale cost allocation, budgeting, and reporting. Excel is valuable for creating custom reports, performing variance analysis, and break-even calculations. These tools help streamline data entry, ensure consistency, and enhance reporting accuracy. Automation also reduces manual errors and improves efficiency in tracking and analyzing costs, aiding in timely decision-making and cost control. 19. How do you handle cost accounting in a manufacturing versus service company? In manufacturing, cost accounting focuses on direct materials, labor, and overhead tied to physical products. Methods like job or process costing track production expenses. In service companies, the emphasis is on labor and overhead since tangible inventory is minimal. Activity-based costing is often more relevant. For instance, in a consultancy, tracking hours and resource usage is key. The principles are similar, but the application and cost drivers differ. Each environment requires tailored systems for accurate cost tracking and analysis. 20. Describe a challenging cost accounting problem you've solved in the past. In my previous role, a manufacturing unit faced discrepancies between projected and actual product costs, impacting pricing. I performed a variance analysis and found that indirect overheads were being underabsorbed due to outdated machine hour rates. After updating the overhead allocation base using activity-based costing, accuracy improved, and we identified cost-saving areas. I presented a report to management with revised pricing recommendations and efficiency improvements, resulting in better cost control and profitability. This experience highlighted the importance of accurate cost allocation and proactive analysis. These 20 cost accounting questions and answers offer a solid foundation for your interview preparation. Review them thoroughly, stay confident, and showcase your expertise. Good luck with your interview success.